Chevron, CVX, is currently rated a strong buy and the Barkhart technical opinion rating is a 100% buy and ranks in the top 1% of all short-term signal directions. Long-term indicators fully support a continuation of the trend. The market is in highly overbought territory. Beware of a trend reversal. Chevron is due to report earnings before the bell today. Implied volatility is high at around 32%. The 12-month low for implied volatility is 21% and the 12-month high is 41%. The 4 percentile is 87%. That means it could be a great time to be a seller of options on CVX. That coupled with the potential bullish action makes it a great candidate for a bull put spread. Option trade idea 1, sell a bull put spread. A bull put spread is a defined risk option strategy that profits if the stock closes above the short strike at expiry. To execute a bull put spread, an investor would sell an out-of-the-money put and then but a further out-of-the-money put. Bull put spread trade involves selling the February 4th expiry 136 strike put and buying the 133 strike put. Selling this spread results in a credit of around $1 or $100 per contract. That is also the maximum possible gain on the trade. The maximum potential loss can be calculated by taking the spread width, less the premium received and multiplying by 100. That give us 3 to 1.00 x 100 equals $200. If we take the maximum gain divided by the maximum loss, we see the trade has a return potential of 38.89%. The probability of the trade being successful is 50%, although this is just an estimate. The spread will achieve the maximum profit if CVX closes above 136 on February 4th, in which case the entire spread would expire worthless, allowing the premium seller to keep the $100 option premium. The maximum loss will occur if CVX closes below 133 on February 4th, which would see the premium seller lose $200 on the trade. The break-even point for the bull put spread is 135, which is calculated as 136 less the $1 option premium per contract. Option trade idea 2, sell a naked put. Naked options are hugely risky and should only be considered by very experienced traders. The potential losses are unlimited, up to the point of the stock reaching $0. That's unlikely to happen in the case of CVX, but naked puts could still suffer significant losses if the stock has a large drop in price. Naked puts should be traded with extreme caution, and only by large traders. A naked put is a mildly bullish strategy. It will make money if the stock rallies, stays flat or doesn't drop by too much. The first example is selling the 135 strike put option expiring on February 25. Doing this, the trader would receive a credit of around $4.90 or $490 per contract. That's theirs to keep no matter what happens to the stock over the course of the trade. However, the investor does have an obligation to buy 100 shares of the stock at $135, if the stock drops below that level. With a naked put, the idea would be to try and avoid assignment, by closing early or adjusting. If CVX stays above 135 and the put expires worthless, the trader makes a 3.8% gain in just under 1 month. That works out to be around 47.4% on an annualized basis. The break-even price for this naked put is calculated by taking the strike price minus the option price. In this case that would be 135 to 4.90 equals 130.10. The maximum loss would occur if CVX went to 0 on February 25, which would see the trade lose $13,010. Mitigating risk. With any option trade, it's important to have a plan in place on how you will manage the trade if it moves against you. For a bull put spread, setting a stop loss of 1.5 times the premium received is a good idea. In the case of the CVX example above, that would be a loss of around $150. For the naked put, a stop loss of 1.5 times the premium received would also be prudent. In the example above, that would involve closing the trade if the loss was around $735.